to Money Mondays, powered by the Joseph Business School, where we bring you up-to-date money news for your personal finances and businesses. I am your host, Jill Thompson. Be sure to tune in for new episodes every first and third Monday of the month. Today on our podcast, we are discussing 2020 taxes for individuals. Filing this year will be different due to some stimulus-related legislation and some usual inflation adjustments. We will discuss tax law changes and how they affect your filing for 2021. Our guest today, Raphael Tulino, is an IRS public affairs officer and has been with the agency for 19 years. The IRS, the Internal Revenue Service, is a bureau of the U.S. Treasury Department and one of the world's most efficient tax administrators. In fiscal year 2019, the IRS collected almost $3.6 trillion in revenue and processed more than 253 million tax returns. Mr. Tulino, welcome to our Money Mondays podcast.
Thanks for having me. I'm glad to espouse as much as I can about taxes for our time.
This is awesome. So we're pretty excited about it. So as we know, of course, filing taxes is an annual thing that everyone has to do in the U.S. And what we wanted to talk to you today about is a lot of things that have transpired within the last year around the pandemic. And so number one question I think that's on everybody's mind is the stimulus. Do we file them or no?
Okay, so the first and second round of the economic impact payments, AKA stimulus, as you say, round one came along in the spring from the CARES Act in 2020. And then the end of the year consolidation Appropriations Act right after Christmas. Both of those brought economic impact payments. And the general answer is no, they're not taxable, and you should not or you do not need to include them in gross income.
Okay. So when we're filing this year, are there any new laws or rules that have taken place that we should be aware about as individuals?
Yeah, there's plenty. So I mentioned the CARES Act. There's a lot that came along from that act from March of 2020. So it's just about a year old. And that really addressed a lot of things at the beginning of the pandemic that we saw, a lot of COVID tax relief. So tax relief for individuals and businesses and health and retirement plans, that kind of thing. So you had relief for employers to employees, for example, if they were caring for a child or a family member with COVID or they had COVID, that kind of thing. So there's all kinds of things based on that. There was also the Families First Coronavirus Response Act that came along. That Consolidation Appropriations Act came along in late December. So there was three major pieces of legislation I'm thinking of off the top. It all brought all kinds of different avenues of tax changes, if you will, for individuals and businesses and the such. And certainly when you file a return here for 2020, if any of them pertain to you, you're eligible for them, you can take advantage of them as deductions or credits, you should. And how do you find out about them? Well, generally, if you're using a CPA or a tax professional, tax preparer, or if you're a business, you're using a bookkeeper or a firm, or you're self-preparing, the software will lead you to all the things you're going to want to know so you can take advantage of them on your tax return.
That's good. And so for those who've experienced significant amounts of loss, whether it be job related, their own personal property as far as their homes or even their retirement portfolios taking a dip with the different increases and decreases that have happened with the market, what's available to help them reduce their tax liability?
Oh boy. So you mentioned job loss. Job loss is unfortunate. We have a nice publication, actually. I remember kind of reading and sending out in social media last year. It's called The Tax Impact of Job Loss. I believe it's publication 4128. And it explains how job loss can affect your taxes in general. But we had a lot of folks that moved maybe from a W-2 salary into the gig economy, for example. Perhaps you got a job driving food around for one of the major social media outlets for that, or other sorts of avenues of gig economy work. So you went in from W-2 to 1099 work. So you had a change in the way your income came in. Other things that people may have done this year, you may have refinanced because mortgage rates have dipped so low. So there's information you're going to want to know about that in terms of points, deductibility of that on your tax return, that kind of thing. But man, there's so much out there. It just depends on the situation you're in. If you're in the unfortunate situation about income dipping, perhaps you qualify for the earned income tax credit, which you didn't before, which is a tax credit given to lower to moderate income individuals and families for having earned income. And perhaps your income dipped this year. And if that's the case, perhaps you qualify for that tax credit, which is quite significant in terms of a refund boost it gives to people. So other things that you could think about is unemployment. A lot of people got unemployment. That is taxable. So if you didn't withhold taxes from that at the federal level, you might see a surprise this year. So going forward, knowing that unemployment is taxable now, perhaps you saw that surprise if you're preparing returns or your tax professional alerted you to that, then do some planning going forward here in 2020 to allow for that, so you can avoid that surprise again next year. So there's a whole wide range of stuff there that's affecting us all in some way, shape, or form. It just depends on the situation you're in and what kind of taxpayer you are.
Yeah. And you brought up something very interesting. I know you talked about that there are a lot of people who are taking on more contracted based work this year and are moving from a W-2 employee to more contracted hire. And for those individuals who may have already owed the IRS funds from the previous tax year, but maybe fell on some hardship last year, what's available to them?
Lots. In terms of flexibility, the IRS came out actually in November with more flexibility than we've ever provided than we normally do, because we know folks are affected by this pandemic in some way, shape, or form. So you're talking about extensions of time, if you will, for installment agreements, so the amount of money you can have in order to have one of those, offer and compromise, that kind of thing, delaying of collections, that kind of thing. It's a whole wide range of stuff in terms of the expansion of flexibility we have to work with taxpayers based on their specific set of facts and circumstances. So if you're in the position where you owe, you haven't been in a position where you owed before, there's no real reason to panic. The IRS wants to be a help and not a hinder, and kind of help you through it in order to stay compliant based on your situation. So installment agreements are the most common way of doing that in terms of paying taxes over time. But one thing to mention though, is if you're in a position where you have a requirement to file a tax return, and some people don't, but most do, then you have a balance due, then you do want to file the return and at least pay something if you can't full pay, because it's much greater of a penalty to not file with a balance due than to file the return and not full pay what you owe. You can always send something in, even if it's a small piece of whatever you owe, and let the agency know, hey, I'm in a situation here where I can't full pay. I need to kind of work this out over time. And we have the flexibility to do that. So consider that as opposed to not filing at all when you have that balance due. Now for refund returns, there really is no penalty or anything like that for refund returns. You're just letting the government keep your money for you, so to speak, until you file that tax return to get your refund back. Now refund basically, to take a step back from that, as you may know, Jill, is basically you're over withheld. You had too much money given to the government throughout the year, and when you file your return based on your situation, all the deductions and credits and the dependents on your return, and you and your spouse, your family, that kind of thing, you get money back because you over withheld. So tax planning is always a good idea, and consider those refunds moving forward, especially considering all the changes we had in 2020.
That's good. Raphael, you know what I want to address, and I'm sure a lot of people are thinking about this right now. There are a lot of W-2 employees who have incurred business-like expenses since working from home. And so many of them have had to purchase new equipment, whether it be laptops or printers or scanners or any other type of technological devices. And also their utility bills may have increased as well. Is there anything that W-2 employees can do where they can minimize their tax liability as well, knowing that they're not necessarily a business entity, but they do have these business-like expenses?
So let me address that real quick. Remind me to go back to the W-2 1099 in terms of compliance there for a minute. But in terms of your question, generally speaking, the law changed from 2017, the Tax Cuts and Jobs Act, which was a big law that fundamentally changed taxes going forward at that time. So beginning in the tax year 2018. Well, it pretty much eliminated unreimbursed business expenses subject to 2% of adjusted gross income as it was. So therefore, the general answer is if you're an employee working at home, the home office deduction is not available to you anymore per the law. Now, if you're self-employed or an independent contractor, then it's still available to you. And that home office deduction is something you should take if it's regular and exclusive use in a principal place in your home where you do business. And those are the general pieces of information about it. But taxes, mortgage interests, repairs and maintenance and things like that, insurance in your home qualify based on if you qualify for the home office deduction in general. But to go back to your question, generally, no, employees do not get the benefit because the law changed. And so it's a little bit different this year. And unfortunately, as the bearer of bad news here, I'd like to just at least present it as reality, because unfortunately that's what it is. Real quick though, because I had the top of mind and I apologize, I wanted to get to it. If you did move from a W-2 to a 1099 kind of employee, and that goes back to the unemployment thing, perhaps you didn't have salary withheld from your paycheck. So if you move into that this year and you're getting money basically as an independent contractor, and you're not having taxes withheld, then you can make quarterly estimated payments going forward, because taxes are pay as you go. And you kind of want to make sure you're compliant there as the year progresses. And that way you don't have these surprises that some people find when they actually get to filing a tax return because they owe too much. So keep in mind that that kind of a thing is available to you, quarterly estimated payments, withholding estimators on irs.gov that can help you kind of stay there. But the bottom line is a lot of that should be addressed for you as a taxpayer, just so you don't get too far one way or the other. Big refund, owing a lot, try to stay more down the middle. That's a better way to go generally.
Is there anything available to parents who may have children that are at home with them as well? Maybe, of course, we know that they're not necessarily teachers or anything like that, but is there anything that's available to parents who have students that are at home right now?
I believe if they were caring for coronavirus, children, in that case, there were credits available based on the employer tax credits, and then for employee as well, getting them from the employer was able to take a credit for that employee, that kind of a thing. But when it comes to that, the only thing I think of off the top is education expenses, and there are deductions, tax benefits for education. That's an IRS publication 970. If perhaps I don't know, you had a Coverdale ESA account or Coverdale ESA, and maybe you took money out or could take money out to get a computer, but even that's nothing taxable if it's a qualified expense for education in that account. So I'm just trying to think off the top, nothing that I can think of, but if it's available on your tax return based on the software and what your CPA tells you, if there's a different situation, then by all means, per eligibility, you should take advantage of it.
You know what? And staying in that vein of thinking about deductions, like has the level of what can be deducted to charitable organizations changed for this year?
There was a change in 2020. So this year in 2021, to kind of separate that, we're talking about planning for now. So going back, we're filing for 2020. So in those laws, CARES Act, for example, and the laws that came on, there were some changes for charitable contributions that were different from years before. For example, you can deduct up to $300 in 2020 above the line, so to speak, meaning if you don't itemize your deductions, up to $300 as donations, cash contributions per the law, which was not available before, because normally if you want to take a charitable contribution, it goes on an IRS Schedule A, but that was new in 2020. So if you did that, you want to account for that. The other thing about it is the AGI limit, which is adjusted gross income. It was 50% for years, 60%. It went up to 100% per the law. So you could deduct up to 100% of your income in 2020 as well. These were changes that were brought on by the pandemic and in legislation. So there's those kinds of things. And I believe, if off the top I'm thinking, there was a change for corporations in terms of what they could deduct as well. In fact, a couple of changes there for them in terms of their ability to give away to qualified charities to benefit communities as a whole. But you get the idea. There were changes. Now in 2021, is there anything different like 20? I believe most of those laws ended in 20. So going forward in 21, you want to check to be sure in terms of charitable contributions and the general rules, which have been the same for a long time. But going back to 2020, yeah, we did have some significant changes there in the charitable arena, no question about it.
Okay. And you know what? And thinking about the AGI specifically, we know that there are probably a lot of couples who have been working from home right now during the pandemic. Is there any benefit at this point to filing jointly opposed to head of household? Is there a distinction?
Okay, so there's 5 filing statuses, if you will, right? So married filing joint and married filing separate are the two for joint couples or partners and spouses. And then there's head of household, widower, and single. The most common are single and married filing joint. Now, if you're a married taxpayer or considered married in the year from which you're filing the return, i.e. 2020, then you have to either file joint or separate. You have to choose one of those. Now, for the most part, married filing joint is much more beneficial in terms of tax benefits than married filing separate. Married filing separate tends to be more penal, if you will, in terms of the amount of tax benefit it gives you to file that way. But it could benefit you married filing separate depending on your situation. So that's going to depend on the couple. For example, I would assume, if I'm thinking about this right, if you marry somebody and they bring a whole lot of debt into the situation or something like that, then maybe married filing separate is better than married filing joint, depending on the situation. It can get complicated when you're talking about debt and maybe insolvency and bankruptcy. But generally speaking, you're going to file a joint return if you're married to get the most benefit. That's the kind of the bottom line.
Okay, understood. And so, I just want to switch a bit to our seniors, because I know we've had a couple questions that have come down the pipe regarding how come some people have to pay taxes on Social Security while others do not.
Social Security is a little bit of an interesting animal. The general rule is if you're a senior citizen and the only income you get is from Social Security, then generally you don't have a taxable event and don't need to file a tax return at all. Now, that said, there are times when if you have more than just Social Security, perhaps you have pension income, other income coming in, perhaps you have wages that come in, then there's a base amount for your filing status and a little bit of a formula there. And it's like half of your benefits plus other income, if I'm thinking about it right, that in this formula that you would have to pay taxes on your Social Security. And Social Security tax, the taxability of Social Security is up to 85%. I think it's 85% of the amount you receive is the maximum amount. But to bottom line it for you, it's a little more, it's not as simple as your question, unfortunately. But here's the good part. The software does it for you, all this stuff. So if you're in software and it's asking you questions about SSA, 1099 income, and when you got it, how much you've got it, perhaps you had a spouse that passed away, you get these benefits that are different. The software is going to help you see through that. But to answer your question, it's because the law provides, and we have to administer it appropriately based on what I just mentioned in terms of how. And so that's kind of it. But software leads me back to that. It makes it so much easier.
That's good. And so for those of our audience members who are listening right now, and just thinking about this whole transitioning between W-2 and 1099, sometimes people just don't understand what's considered to be taxable income versus non-taxable. Can you explain the difference between the two?
Sure. There's all kinds of income. Income comes in terms of services and property and things like that. The IRS has a nice publication on that, 525. It's exactly how you kind of termed it, non-taxable and taxable income. It's at irs.gov, and it explains generally what is taxable or not. There's also a code section that generally says that all income is generally taxable unless accepted by law. Mm-hmm. So you're talking about wages and fringe benefits. Perhaps you're talking about bartering. You're talking about business income, maybe from S corporations and things along those lines. When you're talking about disability and things like that, perhaps life insurance proceeds, some of that is taxable, some is not. Certain military and government disability pensions and benefits are not subject to tax. Some are. Welfare, public assistance benefits. So you have all these different sources of income. It's hard to say based on, I just gave you some general, of course, but the bottom line is, for the most part, your wages and income earned and income provided or earned by you, either unearned or earned, is going to be taxable. But that publication is pretty good, publication 525, in terms of explaining exactly what situation you might be. Or if I can go back to software, it'll help you as well.
Yeah, correct. So, as we're in this, as we're talking, another question that kind of came to mind is, I know a lot of people think about student loans. And so most people, I will not say most, but some people have defaulted on loans and have not been paying for an amount of time. And so let's just say the IRS is at this point in time collecting their refunds because they have defaulted on student loans. What are some ways in which a person can go about getting back or redeeming themselves in a way that they can get their refunds again?
I don't. So off the top, I don't know. So basically what you're saying is if you have a refund and you have this debt, which is a student loan, that's called an offset. And generally that refund goes to paying the loan if you're not paying it. That's true. If you have debt forgiven, for example, that could be a taxable event as well. But student income in general is deductible, even if you don't itemize on a Form 1040. And I believe the number is $2,500 or the lesser of the amount paid throughout the year, in terms of what you can deduct on a Form 1040 for student loan deduction interest, right? But answering your question, I don't know if I have an answer off the top of it to kind of explain exactly how things could work, but it's going to depend on facts and circumstances and that kind of thing. I know there's other things that are outside of the tax world that benefit student loans, like a 10-year window for providing a certain amount of service, having the loan forgiven and all that. But I can only just kind of offer what I just did in terms of offering some information about it.
Mm-hmm. Well, you know what, Mr. Tulino, you've given us like a slew of information, I would say, right now for us to digest. But is there anything specifically that we may have not addressed as a question that people should really just be aware of that may affect their taxes this year?
I would say this year and every year is under no circumstance does the IRS email you out of the blue, call you randomly, send you a text, alerting you to a refund or a probe or a survey or an economic impact payment that you should qualify for, and click on a link or answer this call. Or we're not threatening arrest. We're not threatening a lawsuit. We're not doing any of those things that scammers do using the IRS as a lure. So just be wary if any legitimate agency or company calls you demanding certain things like immediate tax payment, for example, for IRS. We don't do that. Just be wary of those scams. It's a good idea. There's so many schemes and variations and such that you just want to keep your antenna up for things like that. And then one final thing, if you're choosing a tax preparer this year to do it, choose wisely. Find somebody who's doing a reputable and honest return, who's looking out in your best interests. And that way, that you're filing a return accurately. And then if there's information on it that the IRS can ask you about, and we generally do send some letters if need be, but you're going to a reputable preparer if you can ask him or her about it. Try to avoid a ghost preparer or that kind of a thing, because the bottom line is, and a ghost preparer is somebody who maybe will provide the return to you for a fee. It's bogus. They underinflate or overinflate something. Yeah. You're left holding the bag, have to pay the refund back and interest and deal with the IRS, and they're gone. That's kind of what I mean by a ghost preparer. But because once you sign it, you're responsible for the information that's on it. So always a good idea right around now, especially as we right in the middle of at the beginning of a tax filing season, to make sure folks know, choose wisely out there if you're choosing a tax pro, because it's an intimate relationship and you want to get it right the first time.
Yeah. And so speaking of what you just said, it's once you sign it, you're responsible for it. How long typically should we keep copies of our tax return?
Generally 3 years is not a bad idea with all the schedules and such. It could be maybe 6 or 7 years if you have a business or a capital asset, even more. It depends on the situation you're in. Never a bad idea just to keep the 1040 itself, maybe even longer than that, just a copy of the 1040. You may need these things for mortgage refinancing or other sorts of financial instruments and needs along the way. But generally 3 years is the answer. And if you have a capital asset, as I say, if it's a rental home, maybe even longer, as long as you own that capital asset, that kind of a thing. So, but good record keeping is always a good idea. As you get to preparing your return, you want to gather and be organized. That way you don't miss out on anything that could reduce the tax you pay or increase your refund or omit a source of income, that kind of a thing. So just record keeping in general is always a good idea, and perhaps consider the steps you would take in order to do that, to get things right and accurate the first time, so you avoid delays. Or, hey, Jill, nobody wants correspondence with the IRS more than once, right? So
that's true.
But if you do get it, it's usually a letter in the mail, right? And it's a good idea to respond, and it tells you exactly what we're looking for, or the IRS is looking for, if there's a question about your return.
Okay, that's good. And another question, just thinking about keeping the returns, if for some reason someone did not do proper record keeping, and for the last 3 years they have not kept copies of their returns, are there any way that they can contact the IRS to get a copy?
IRS.gov for transcripts and that kind of thing. That's your first stop really for everything. IRS.gov. You can get transcripts by mail as well. You can request a copy of your 1040. I believe there's a fee for that. But do keep in mind that irs.gov is the best spot to go for pretty much everything around now, because the pandemic and just years long resource challenges has really put us a little bit behind in terms of answering the phones and that kind of a thing. So try to go to irs.gov and take care of business there, as opposed to calling. You can call, no problem. We're just staff is a little limited, and perhaps your phone wait will be a little longer than you want to be. But yeah, irs.gov for transcripts or anything else you need. It's the best spot to start.
Raphael, who should file their taxes?
So the requirement to file a tax return is generally about income threshold. So income, age, and filing status. So generally speaking, if you don't meet a certain threshold of income to file a tax return, you don't necessarily have to file a tax return. I suppose the better question, however, and that general answer is, let me go back to that real quick. It's the standard deduction number is what it is. So the standard deduction for 2020 is $12,400, and it is double that for married filing joint. So if your income doesn't rise to that level, you don't necessarily have to file a tax return. Now that said, by law, the better question, I suppose, is who should file a tax return? And even if you have some income, depending on your situation, you're lower to moderate income individual, family, whatever, there are a whole bunch of things you can qualify for to really significantly boost a tax refund that can come your way. So who should file? Perhaps an employee or somebody who had a part-time job and had federal tax withheld. Somebody who had in that situation, or a family who had just minimal income but qualifies for the earned income tax credit or the additional child tax credit, or any of the other credits that are available for lower to moderate income individuals and families. So really it's who should file or who should consider filing. It's true you don't necessarily have to file if your income is below a certain level. As I mentioned, for Social Security recipients, if that's the only income you receive, then generally you have no requirement and you don't have to file a return. But on the other end of the scale, a lot of folks should file, and that way they could take advantage of the tax benefits that are written in law that would benefit them.
And so how do strangers pretty much react when they find out that you work for the IRS?
Yeah, sometimes good and sometimes bad. I've been in positions where at a party or something, I remember I was at a party once years ago, I think it was a Christmas party, and a friend said, "Hey, this is Raphael. He works for the IRS," to some stranger. And I thought, uh-oh. And the way this person was dressed and the way he looked and his first reaction, I thought, uh-oh, I'm about to get a mouthful. But he said, he looked at me, took a deep breath, and he said, Raphael, I have to tell you something about the IRS. And I thought, oh boy. He said, I worked with them once and they were the nicest, the kindest. They helped me all the way through. So it was a real complimentary kind of thing. On the other hand, I was at a golf course once and playing golf late in the afternoon one day just to get 9 holes in near where I live. And I walked out to the tee and joined an older couple, a senior citizen couple, and went off the tee just for a couple hours. And by the time we got to the 3rd hole, the lady, they asked, so Raphael, what do you do? And I explained to him, and she looked me in the eye, this small little cute lady, nice golf swing, the whole thing. She looked, and I thought fire was gonna come out of her mouth. Anyway, she looked at me, she looked at her husband, and she said, "You work for the IRS?" I said, "Yes, ma'am." She turned to her husband, who was sitting in the cart right there. I'll never forget it. She said, "Hey," I forgot his name, John or whatever. "Hey, whatever you do not tell him anything about us. No social security number. Do not tell him our last name. Nothing. You understand?" And he's like, "Well, okay." And I thought she was kind of kidding, but she wasn't. And yeah, for the rest of I actually after like the 6th or 7th hole, I kind of just cut out. I was very uncomfortable. This poor lady had a very strong bias. So I guess you never know what you're going to get when people hear you. And other things, there are reactions when you go into newsrooms or radio stations and things, and certain jokes that are made and that kind of thing. But try to make it as light as you can, because for a lot of folks, taxes are a serious matter, and that's understood. So discussing them coming from the IRS, you try to lighten up a little bit and provide the fact that, hey, we're not a faceless bureaucracy. We're here to help as much as we can and provide the resources so we can do that. So yeah, I guess that's kind of a quick overview.
Hey, if it were me, I think you were a friend. I mean, hey, having a friend who works for the IRS is like having a good ally who can help me with some great tips of how I can reduce my tax liability. I see it as a benefit.
Amen. Thanks for saying that. So yeah, it's true. That's true. We're here to help if we can.
And you know what? This is our last and final question, but it's a 2-parter. Is
Okay.
there any way or any tip that you can suggest to our audience members as they're beginning to prepare for their taxes? I know that oftentimes we kind of wait to January or we wait to December 31st to begin to start compiling all the information together. But are there any tips as to what we can do prior to this time to make sure that we're ready at the top of the tax season and not kind of scrambling around to try to find information? And the second part to that is has the final filing date changed at all as far as April 15th, or is it the same this year?
April 15th is a deadline in 2021. That hasn't changed. And I guess to answer your question, I always think of maybe doing some organization throughout the year as best you can. And that way you avoid any overwhelming processes, if you will, in terms of year end, because there are folks out there who have lots of paperwork. If you own a business or you run a business or you're self-employed and you have all these papers and deductions and receipts and things like that, whatever you can do to electronically do that, there's lots of software for that as well. But I always think some organizing as you go is a good idea so you don't overwhelm yourself. And it's the same kind of logic, I suppose, in doing a tax return. Perhaps gather it together, take some time to do that, come back to it later, realize, okay, I got it in this space, I got it in that spot, I got it here. I'm ready to get to the computer and do it, or I'm ready to give it to my CPA in a nice organized format so they can file that return for you and not charge you extra money to organize what you could have done yourself, that kind of a thing. So I guess the bottom line is good organization is never a bad idea as you move along with finances. I think so, at least. And I hate to bring my opinion into things, but it definitely, I think it helps.
Mr. Tulino, thank you so much for coming on our podcast. Are there any other resources where if people have additional tax questions that they may have for the IRS where they can go for information or resources?
IRS.gov. I mean, that's number one, and it's the IRS.gov, not .com. So IRS.gov for everything you need. You think the taxes, filing, free, this, that, and the other, forms, publications, downloads, task-based tools, so many of those, IRS.gov.
Thank you so much for coming on our podcast today.
Anytime, glad to be here.
On our next episode, we'll be discussing business taxes. If you have any questions for our expert, be sure to submit them in advance to moneymondays@jbs.edu. Don't forget to subscribe and hit the notification bell on our JBS YouTube channels and social media outlets. I'm your host, Jill Thompson, and I look forward to seeing you prosper.